Hi folks, today I'm going to talk about investing through Gift City for resident Indians. From what I could find, there are two live products. One is the DSP Global Equity Fund, which is a mutual fund style product, and the other is unsponsored depository products, which helps us invest into some US stocks. So I'm going to take you through the advantages and disadvantages of these two products. Let's take the DSP Global Equity Fund first. It is the only mutual fund style product which is available currently. And this is housed out of the Gift City, which is the International Financial Service Center, which is based out of Gujarat. The advantages of investing through this fund is firstly, of course, diversification. We get to invest in markets other than India and therefore will have a lower correlation with Indian equities. This fund promises to invest in stocks across US, Europe, Japan, South Korea and Taiwan, and in dominant businesses currently like AI, biotech, EV, infrastructure, etc. So this gives us the potential to invest in global companies that are doing well. Since this is a US dollar denominated asset, this should potentially protect us against the depreciating Indian rupee. So if you have aspirations of sending your child abroad or any other global aspirations, then this could be a positive factor. The tax treatment for the investor at the time of redemption is also favorable because the gains are taxed at the fund level only. It doesn't affect the investor. What are the disadvantages here? So firstly, this is a new fund. It was launched in June 2025. So the fund itself does not have much of a track record. Also, there is not much publicly available information on the fund performance till date and other related matters. Investors currently have a limited option of investing in the sense that if it is offline, then you have to send forms to the fund house. If it is online, then you can only invest through the IND money platform, and that too it is restricted to HDFC Bank account holders. This is as per the DSP Global website. So it seems that most investors will find it cumbersome to invest into the fund. The expense ratio of the fund is also similar to Indian equity funds. So there is no real advantage to be found there. If we go directly, the expense ratio is 1%. If we invest through a partner, then the expense ratio is 1.75%. One of the major disadvantages I found is that we cannot invest through the SIP route. There is only lump sum which is allowed. SIPs allow us to invest in disciplined manner and it helps us average out our costs because we are investing even during the low periods. This feature not being there is not good for investors. And SWP, that is systematic withdrawal plans, are also not allowed. Hopefully the fund will introduce these two features in the coming months. Let's look at the tax implication. This product falls under LRS, which is the Liberalized Remittance Scheme. As per the norms, if you remit more than 10 lakhs abroad, then 20% is collected at source, TCS. So it means that a huge chunk of the investment amount could be kept away as tax collected at source. To be clear, TCS is not an extra tax. It is an advanced tax filing which can be set off later at the time of your filing if your tax liability is less than what was collected. In India, if you hold the investment for more than 12 months, then that investment will qualify for long-term capital gains tax. Whereas in this scheme, you have to hold it for more than 24 months. Short-term capital gains are very high at around 43% and the long-term capital gains are at 15%. To summarize, the DSP Global Equity Fund is an important step for resident Indians to invest abroad because we can do it in a regulated manner and with the tax structure being clearly in place. However, considering the limitations and the short-term tax implications, one has to really be careful before investing into the product. Now coming to the UDRs, which is the unsponsored depository products, I couldn't find much public information. There are a few sites which had some information and I have culled the information basis that. So how do UDRs work? A custodian buys these foreign shares and holds them. Against these, receipts are issued which can be traded on the exchange. Now in India, NSE, IFSC is holding these foreign shares and have issued UDRs or receipts against them, and brokers like SDFC, Anand Rathi, Edelweiss are helping us to invest and trade in these shares. Currently, we can trade in shares which are the top 50 of the S&P 500. So these include some of the big names like Apple, Nvidia, Microsoft, Google, etc. To take an example to explain this, let's look at Apple. So Apple shares today are roughly around $250. There is a specified DR ratio which is used to convert an Apple share into UDRs. So if there is one Apple share of $250, then this gets converted to 25 UDRs of $10 each, because the DR ratio is 25:1. So you see how the Apple share has now got converted to smaller tradable units. But there is a catch to this. While the unit itself is priced more attractively for us, it could be that the broker sets a minimum investment ticket size. So we may have to invest or at least commit a significantly higher amount to start this with. So this was one of the key concerns that I had. Apart from this, there is no public information. Even the NSE IFSC site was down when I tried to access it. There is no information on the minimum commitment, the ticket size, the operational formalities, etc. So I think we should wait for some more time before we get into this product. Apart from these, I could not find any products which are suitable for resident Indians which are live. If you know of any, please do drop it in the comments. If you have any queries also, please do drop it and we'll be happy to get back to you. Thanks for watching.